Well, welcome everybody. Thank you for being with us for Middleton Elite Coaching's 2025 market update. We're going to get started here in about 30 seconds. Thanks for being on time. Give you just a second to get settled in, and then we are off to the races. All right, here we go. Well, 2024 has been an interesting year. We're in the home stretch here. The on-ramp for 2025, as I'd like to call it, over the next hour-ish, depending on how deep we get into some of the details I'm going to lay out for you. The way we here at Middleton Elite Coaching see 2025 playing out. Of course, these are just our well-researched best guesses and things that we're working with our clients on every day. For those of you who aren't really familiar with us, we focus on coaching the top 1% of teams and brokerage firms in the real estate business. I'm coming into my 17th year of doing this, if you can believe that. And we got a lot of good stuff to cover today. Let me just go ahead and just dive right in. Here are kind of the key topics for you. You will also be getting this as a recording. You'll be getting the slide deck and some other resources sent to you via email. If you're watching this recording in other places, you can find that on our website at middletonelitecoaching.com. We're going to start out with where the market's been over the past few years, just to give you some data behind that to help sort of set the stage for the story, where the market's likely headed in 25. And we're going to get into kind of the key topic of today's conversation, and one that if you've been around me for a while, you know forms the base case for determining where the market is headed directionally, both in units and in prices. We're going to dig into buyer demand and the things that drive that, seller supply, and where that is likely headed. The big topic that I know you're hearing from everyone in your spheres of influence is the question about mortgage interest rates and where they're headed. I'm going to propose to you that it might not even matter. So hang with me on that. We'll get into why now is a fantastic time to be a buyer. I've got a little exercise I'm going to walk you through that I think is going to be a very valuable script for you to use with those buyers that you have who are sitting on the fence waiting on rates to come down. Then we'll also touch on whether sellers should go ahead and list now or list in the early spring or wait for market conditions to continue to improve relative to buyer demand and rates. And rather than just sharing a bunch of opinion with you, which I will also do, I'm going to share with you the data behind all of it. So thanks for being here today. Buckle up. Here we go. Here's from NAR, and we'll cite our sources throughout, both in the presentation and in the resources that you'll get after this. Here is a roughly 4-year trend line of existing home sales. You have felt this. And essentially, what this is telling you is that over the past roughly 4 years, coming out of the post-COVID peak, that was sort of like the 2-year-long frat party, we have seen units drop roughly about 40%. This annualized number of 3.9 million that was the October reading from NAR's existing home sales report is by most accounts one of the lowest numbers. Actually, the prior month probably was, but one of the lowest numbers that we've seen in decades. So if your business is down in units, you're not the only one, but you're probably also trending along with the market. Hopefully what you're going to get out of today are some strategies to outpace the market. But that's about a 40% drop over the past 4 years. Good news here, I think we found the bottom and we're slowly working our way up off of that bottom. The speed with which we do that is yet to be determined, but most estimates have us for next year in about like the 4.3 to 4.6 million units nationally, which would get back above some of these levels back here. All right, so that's what's been happening with units, but at the same time, a little bit counterintuitively to most of the general public, but you know this because you're in it every day, prices have continued to go up. Although this doesn't go back a full 5 years, the magic number here is up about 56, 57% in median home sale price over the past 5 years. For many of you, that's probably why you've been able to sort of hold the line on your GCI numbers or your total income numbers over the past few years, even though units are down. This is also, as you well know, this is also what's driving the challenges in housing affordability. It's also kind of sticky in that CPI number as well. But silver lining here for us is that home values continue to go up, and as I'll show you later, likely will continue to do so into the future. So that's a little backdrop for you, but let's get into the base case. And as I mentioned, if you've been around me or our coaches or our company for quite some time, you know that we're big about having foundational models or filters to run things through. So to hang here for just a second, perhaps you're getting the question, and certainly have gotten it before, about where's the market headed, or what's happening with prices, or what do you think is going to happen with rates, or what do you expect is going to happen next year? And the way I hear most agents answer that is some combination of like, well, I heard this, or I hope that. And if you've ever said either of those things, it's not that you're wrong. We just want to give you a little bit more, I guess, like meat on the bone to go with that. So we think there are three things that drive buyer demand. And historically, I've said two things that drive seller supply, but I've added a third here in the incentives and tax policy. I would propose to you that the direction of the real estate market is not terribly difficult to predict as long as you're watching the underlying metrics that drive the relationship between buyer demand and seller supply. And you're probably thinking like, all right, Middleton, is that the best you've got for me? Some Econ 101? Well, sort of, but I'll give you a little bit more behind it. And I think a lot of helpful things that you can use in your listing presentations, your buyer consultations, et cetera. So let's go one by one through each of these. First, I'll tackle buyer demand and net migration because this is really the story. I have a handful of slides on this topic. Around about January, you're going to see reports come out from large companies like U-Haul and United Van Lines, and these big moving companies. Pods actually just released theirs maybe a week or two ago. So I pulled some of their data because it's relatively updated compared to those that'll come out next month. I am not confused, by the way, for all my friends in the Carolinas, which I happen to be one. I'm not confused that Myrtle Beach and Wilmington are two different cities. I didn't create the list. I just put it here. But you have a pretty good idea, and most of you know this intuitively, that there's a lot of migration to the Carolinas. There's a lot of migration to like East Tennessee, North Georgia, parts of Texas, and then a few markets in Florida. There's a little bit of a reversal in some trends in Florida on the coasts that have some outbound migration because of a combination of prices and insurance rates and some other things that we won't touch on a whole lot today. But this gives you an idea of inbound migration from these sources. The Realtor.com study here that's linked to in the slide deck that you'll get is looking at inbound and outbound. So those are long distance moving requests. Here's one. This is a lot on one slide, but I wanted to jam it all on one in case you want to rip this one off and use it. This is from a data aggregator called Move Buddha. But let's look at this heat map over on the left. Really, all you need to know here is that green is inbound and red is outbound. Dark green is more inbound comparatively, and dark red is more outbound. And then they'll show you over here in this table on the right-hand side, their ratio of like this left column is number of inbound moves relative to 100 outbound moves. And then you'll see, Carolinas, Maine is a really interesting bright spot here. Tennessee, Idaho, which is mostly people leaving California for Idaho, similar to Wyoming. And then you'll see the outbound states. Not terribly surprising on most of the outbound states either. But this can give you an idea if you're in one of the outbound migration states, your opportunity becomes really to focus on the listing inventory that's coming up as a result of that. The underlying factors that are driving the net outbound migration, which, broadly, we probably all know what they are, but they could vary a little bit in your micro markets. If you're in one of these green states, particularly one of the darker green states, your strategy is to be more purposeful about how you're generating business in those feeder states, how you're utilizing marketing in those areas, how you're utilizing agent referrals in those areas, how you're taking people in your past client group or your database who have moved from other places. So I'm here in Hilton Head, South Carolina. A lot of people from all over the country move here. And then, so if I were to say to them, who else do you know in the city that you moved here from who might be thinking about moving to Hilton Head? That would be a great way to use your existing database for like 1 degree of separation to somebody who's moving in. This is really the big factor that's driving though prices. Is if you're in these dark green states, your prices are going up. If you're in these dark red states, you've got downward pressure on pricing because that's creating some excess supply. NAR just last week did their forecast summit, and along with that, they produced a housing hotspots report. Very great report. I would encourage you to read it. We'll link to it in the resources. But here's the summary statement of it with a little map to go along with it. Their prediction is that these are the top 10 markets that they see. So this is price appreciation and inbound migration related. Again, not a ton of surprises here. I will draw just a brief distinction for those of you who are in New England. If I go back a slide here, the Move Buddha study has Massachusetts as a state as one of the higher outbound states, but the NAR report has the Boston metro area as one of the hotter markets. So I'm mentioning this to say that you could actually be in a state that exhibits data of high outbound migration, but you could be in a metro area that is comparatively better off. And if you're in those markets, you'll know why. But it gives you, I think, a really good example of what we've heard for as long as you've been in this business, is that real estate is local. However, some of these markets have been on the list for quite some time. Charlotte Metro, Greenville, South Carolina Metro, San Antonio, Knoxville is a very rapidly growing area. So a number of these have been on similar reports for the past few years as migration really accelerated post-COVID. I'll give you some more data behind that in just a second, but if you're in these markets, you can feel quite certain that you're going to continue to see price appreciation because buyer demand is checkbox number one through net migration. The second piece that drives buyer demand is demographic waves or demographic cohorts. Some of you have heard me talk about this quite a bit, but you're looking at millennials and you're looking at boomers, who are statistically the two largest demographic cohorts in the history of the country. Millennials have just overtaken boomers in sheer population size, but those are the two, not to discount any of you Xers, I'm right on the fringe of that, or some of the younger Gen Ys that are out there. What we're really looking at here is what's happening with older millennials and boomers. This gives you kind of a percentage of where they are. The light blue are buyer activity. This probably comes as no surprise that you're seeing younger millennials. This number is going to continue to increase just as they get a little bit older, and the idea of living in an apartment with their friends or living in their parents' basement kind of gets old. That number is going to rise to meet some of this like low 20s-ish number that we see with the older millennials. You'll see here this older millennial group starting to rise in proportion of sellers. That's people selling their first home, their starter home, and beginning to move up. This is 2024 data, so this is all very accurate for you. And then the thing that you know, because you're experiencing it once you get up here into boomers, disproportionately you see boomers as sellers, and you see these younger boomers as a percentage still being buyers, whereas these older boomers and silent generation are stereotypically kind of making their last move. They're moving in with their adult children into a multi-generational home, or they're moving into some sort of assisted living or something like that. But this just gives you a good visual way of saying who's playing in the game right now. The thing I might ask you to write in your notes as part of this is I want to really encourage you to build, if you don't already, really want to encourage you to build demographic diversity in your database. Typically, where I see people clustered is that their database is kind of their own demographic cohort. So if you're younger, your database tends to be younger. If you're older, your database tends to be older. And the market would suggest, just in like sheer numbers, that we really need to be focused on fishing in all of these ponds, particularly here between like older millennials and older boomers. So if you're building demographic diversity in your database, and those of you who are building and running teams, one of the shortcuts of that is to make sure that you're building demographic diversity within your team. So if I stick with the trend line that a younger person's database is largely going to mirror their age group, and an older person's database is largely going to mirror their age group, and you have a mostly younger team, one of the shortcuts is to add someone a little bit older to your team and inherit an older database. The inverse of that is also true. If you're running a team that skews a little bit older, one of the best things that you can do is add some young blood into the team and sort of blend that demographic diversity there. So hopefully there's some key takeaways for you on that. Here's a lot of numbers and a lot of words just to say something that you probably already instinctively know, but this is the trend that has been going on from the basically immediate post-COVID era that is going to continue to accelerate. This is reasons that the buyer decided to buy. This is some NAR data from their generational trends report. I just want to draw your attention to a couple of things here. If I get up into this like 59 and older group, look at what percentage of them said their main reason for buying a home was a desire to be closer to family, friends, or relatives. That is the primary reason for people over the age of 59. If I go down here to people like under the age of 58, they're saying desire to own their own home. So that, I mean, obviously that skews really high for this young group because those are the first time buyers. But you'll see some numbers around like a better area or like a larger home. You see here is the more like the move up buyer. But I really want you to key in on these older, comparatively older people as home buyers. And that trend that you see is they're chasing their grandkids. They're chasing their adult children. So you know this and have dealt with this within your business already. I'm just going to ask you to consider making that a bigger part of your lead gen strategy for 2025. Is I want to be talking to these comparatively younger people about getting introduced to their parents who live elsewhere, who might want to, and statistically do want to, relocate to where you are. So some cool stuff to take away from that. All right, so here's the third part of buyer demand, and the thing that you probably really came here for and that your database is asking you about all the time, and that is, where are mortgage interest rates headed? And the short answer is, who knows? But I can tell you that directionally they're headed down. The speed with which they go down is open to great debate. I think if you're watching this live, it's very likely, it's almost 100% certain, if the news hasn't already broke, that we're going to get a quarter point cut from the Fed today. What you also know, though, is that mortgage interest rates have already baked that in. Let's hang before we get to the predictions and just talk about the difference between what's happening with mortgage interest rates and then the Fed's decisions. I don't want to get too far in the weeds on this, and I don't know that it makes sense that you would explain all of this to your buyers or sellers, but there's a mathematical thing that happens relatively quickly, and then there's a lagging thing that creates some discussion within the general public and within your database, and you need to be leaned into both of those. So, as you likely know, mortgage interest rates are not directly correlated to Fed funds rates. They react more to bond markets, and bond markets are reacting very quickly to changes in news. And that's why you see all this talk about CPI and PPI and employment and unemployment and the Fed's dual mandate and soft landings and whatever else. But here's all you really need to know is if the headlines seem like the Fed is on track to get us down to 2% inflation, if the headlines seem like things are on track to keep us at relatively full employment, then you're going to see this slow, smooth, continued decline in mortgage interest rates down to something around 6. So you see here, and I put in quotes where applicable what each of these sources have directly said. National Association of Home Builders, this is a year-end 2025 target. So we're talking about 12 months from now. National Association of Home Builders says, quote, below 6. NAR says, quote, near 6. MBA, 6. Fannie, quote, above 6. In their report, and I really liked this comment, which you know instinctively as well, is that the volatility of rates is going to create some opportunity for buyers. So today I'll give you a few different angles of buyer opportunity. But here's what Fannie was talking about in their report. You've seen this happen over the past 2 years where there is some news event that happens. So here would be an example. A few months ago, there was an unemployment report that came out where the unemployment numbers were higher than expected. And that signaled ever so briefly to the market that it felt like the Fed had overshot this thing, had been too tight with monetary policy for too long. The job market had reacted by either a combination of laying more people off or not hiring as many people. And as a result, unemployment went up, which on a bumper sticker would be bad for the economy. And then you saw rates drop pretty quickly, mortgage interest rates. And when those rates dropped, the buyers who were paying really close attention, and you know this because you saw this surge in buyer demand, surge is relative, of course, but buyers came back to the market really quickly, gobbled up whatever the good stuff was that was there. You had a great month, a month later, 45 days later, and then it was kind of crickets again because the news cycle caused that hard gear shift down in rates. And we've seen the opposite to be true as well. When there are data that suggest, and I'm kind of in this camp that thinks that inflation is stickier than most think, and is probably going to be a little more persistent than most think. And then that would suggest that the Fed's going to have to be a little tighter for longer on monetary policy, which means rates are going to stay higher for longer. And as a result, your buyer demand relative to mortgage interest rates, your buyer demand is a little bit down. So what Fannie's saying here is that when you see these rapid dips, I'll give you Bill's interpretation. You have to have your buyer pipeline ready to go on the drop of a hat. Like they need to know that if you woke up tomorrow and some news event caused the 30-year fix to drop by a quarter of a point or a third of a point or whatever, they need to be ready to go now to beat those other buyers to the market. Because what you also know, and I'm going to hang out here for a few more minutes, is that if rates were persistently low, let's say you woke up tomorrow and the 30-year fixed was at 5.9, which is a thought exercise, not a prediction. But you woke up tomorrow and that was the number, you know what would happen is every buyer who's been sitting on the sidelines would now flood you. There's not enough inventory in most of your markets, unless you're in one of those red states. Red states on the map, not red state politically. There's not enough inventory out there to fill that need. And so you end up with multiple offers and you end up with prices being driven up. I'll talk with you later about why I think buyers are missing a big opportunity right now. But this kind of fits and starts feeling that you've had over the past like 18 to 24 months is likely to continue if all you did was ride market waves. And that's really all Fannie is saying here is that volatility, quick downward moves off of news events would create opportunity for your buyers. All right, a lot of words. Let's keep moving. Goldman's got 6.1. There were a few interesting things in this Goldman report that I linked to, so you can check this out in the show notes. 85% of mortgages are below the current fixed rate. 70% of mortgages, per their research, 70% of mortgages are fixed at 5% or less. That's that group that's like, I don't know if you want to call it like happily stuck or golden handcuffed or whatever, the kind of locked up seller inventory. At some point, though, and I don't know when this will be, but it's going to happen. At some point, as rates kind of trickle their way back down, and life continues to move on for these people, the underlying factors that are over here are going to drive them. You'll notice that um, like they're not citing financial stuff as one of the main reasons that they're buying. Even if we went back to a time when, mortgage interest rates were in the threes and fours, this graph didn't look all that different than it does right now. It's not as if their driving force became, hey, the number one reason I want to buy a house right now is because rates are so low. As you know, people end up making their purchase decisions largely for personal reasons and or emotional reasons, life circumstance kind of stuff. And then they just use rates to sort of financially justify it, or very practically just to make sure that they can afford it. But there's a lot of sort of interesting gold within this. I've already given you my largely my commentary on inflation and the Fed. I'll tell you just briefly though, the other thing that I'm interested in watching, and I think most economists are too. And this is not a political statement in any way. I have an opinion, but it's not going to show up here. I'm purely viewing this from a like how policy and decisions impact or could impact the direction of the real estate market, because that's what we're all most interested in. I think the two big things that everybody's waiting for are the potential impacts of Trump administration proposed tariffs and Trump administration proposed immigration changes. Again, as an economic statement, not a political statement, tariffs are inflationary, and some of the proposed immigration policies that could, emphasis on could, um, shrink the workforce, particularly in construction, that is inflationary. There is a there's a trend line of in all of politics on both sides of the aisle. There is a trend line of big sort of blustery policy being floated, and then ultimately the policy that sticks being a much more watered down version of it. That happens to be my opinion as to where we're going to end, is that whatever ultimately ends up happening with tariffs is going to be a watered down version of the current discussion. And whatever happens with immigration is likely to be a watered down version of the current discussion. Both of those things would be, in my opinion, good for the economy. But that's what the Fed's waiting on. They don't want to cool off too fast to then have inflationary policy decisions made in Q1 or Q2 of next year, and then have to raise rates again. So I think that's why they're sort of doing the cut that the data have given them an opportunity to do, and then I would suspect they're going to kick the can a little bit further. So what does all of that mean? If you're waiting on some big rate relief to cause a snapback rally and go back to 2021, I would encourage you to just release that thought from your mind, because barring any major economic circumstance that we would not want to have happen anyway, it's unlikely we're going to see any major rate relief. Okay, cool. Let's see. Just briefly on this, I don't want to get too tangled up in it. This just shows you kind of what I was talking about from volatility creating opportunities. So this dark green line is the 30-year fixed. And you'll just look for like recent points where there's been a dip. This was that August-ish dip I was talking about. And then the inverse reaction of buyer demand. These are mortgage applications. This is some Mortgage Bankers Association data. So instinctively, you would know rates go down quickly, mortgage applications go up. That is a leading indicator of buyer activity. All right, so what does all that mean on buyer demand before we get to seller supply? In summary, net migration. If you're in a market that a lot of people are moving to, you have more sustained buyer demand. That trend line will continue. That is upward pressure on prices. If you're in a market that has the participation of all demographic groups, which most of your markets do, If you're in more like a resort retirement community, kind of like I am, then it's a little more iffy on the demographics. But generally speaking, most of you are in markets where demographics are your friends, so that's upward pressure on pricing. And then the little bit of wet blanket that you've got on top of things right now that you have for almost 2 years now is that rates aren't as low as people would like for them to be, but there's some meaningful relief coming in that direction. So I would call that like two green check marks and a yellow check mark for buyer demand that pushes prices up. Let's go. Probably the most important discussion that we're going to have today. And I've given a very simple example here. And you have heard or seen or thought of this in some way, but I'm going to bring it to you from a slightly different angle. And I'm going to refer to this as the hidden cost of waiting. And I believe, and if you were at our live event in Raleigh a few weeks ago, you heard me talk about this. I believe that buyers right now who are saying they're going to wait on rates to come down are missing one of the biggest wealth building opportunities of their lives. I don't think that's an exaggerant statement, but we're going to talk about how to prove that to them. I'm going to use this $500,000 number for ease of example. We're going to go with assuming this is a $600,000 house with a $500,000 loan. I just want to keep it super simple. And for discussion purposes, we're going to use this 7%. So this would be the principal and interest payment on a $500,000 loan at 7%. This would be the principal and interest payment on a $500,000 loan at 6%. Now, I know if you're watching this live or close to when I record it, rates aren't at 7 right now, but just hang with me on the general idea here. We're comparing a 1 full percent rate difference. Let me give this next slide and break it down for you. So here's the money that buyer thinks they're saving. This is our $600,000 house that we're putting that we're borrowing $500,000. So the difference is $330 a month. So I'm looking at, in round numbers, the difference between this 7% and this 6%, $330 a month, roughly $4,000 a year. That's green here in my graph because that's what the buyer thinks they're saving by waiting. Said a different way, if they're going to hang out until rates end up at 6, the reason they're waiting is to save $4,000. But let's talk about what happens while they wait. And I would lay this out for you in equity growth that they're leaving on the table. I have 3 what I think are very conservative examples. So this is the $600,000 house at 2% home price appreciation. That 2% number is where the vast majority of targets are nationally for next year. Now, that's taking into account the net outbound migration markets that are probably going to see prices come down. That's taking into account the net inbound markets where you are almost certainly going to see prices continue to go up. So I'm only using 2 because it's easy to validate with some national data. I don't think it's a stretch at all that you could use 4% growth or 6% growth. I think some of these markets that we talked about a little bit earlier, these like top 10 hottest markets, or these some of these markets from the pods research here, I don't think it's out of bounds that some of those markets could see 8 to 10% median home price appreciation in 2025. But part of the way we're going to describe this to buyers is to make it believable without being exaggerant. So I got 2, 4, and 6 here. So your $600,000 house is now worth 612 or 624 or 636 a year from now. I'm not even taking into account the fact that if they bought it a year from now at 624 and they paid 6% interest on it, that their monthly payment is actually higher than what we have here, because now they're buying a $624,000 house at a 6% rate. I don't want to get too tangled up in it because I think it over explains the point that I'm attempting to make. So let's just split the difference here and call it 4%. In this case, the $600,000 house, they missed out on $24,000 worth of equity growth. But what you also know right now is that there's a really big negotiating opportunity in most of your markets. Now, I know in certain little pockets, or if it's like a house that's a 10 out of 10, some of you are still seeing multiple offers right now. Cool. Congratulations. Some of you are still seeing 100% list price to sale price or more on those little specific properties. But more broadly speaking, I think if you were to just be conservative here and say, well, we could probably negotiate a 3% discount on that property right now because buyer demand is comparatively low and sellers are a little bit nervous about things, then maybe we get this $600,000 house for 3% off. So that'd be $582,000. That'd be an $18,000 discount. In some combination of price reductions or seller prepays or contributions to closing cost or repairs prior to or after closing, work that any way that you want to. But I think this is very, very conservative as well. So in this case, we got 24,000 of equity growth. We got 18,000 in discounts. My math says that's $42,000. Offset by the $4,000 that they're going to save. So in this case, round numbers, $38,000 of wealth building that buyer is leaving on the table while they wait. Pause. All of this is rational math, and manipulate it any way that you want to make it match your buyer and their needs. You could see how even if I, watered this down to 2% growth and I watered this down to 2% discount, we're still talking about tens of thousands of dollars of difference. But all of that is still rational. And what you all know from like Sales Training 101 is that rational stuff's going to make them think, but then it's the emotional piece that's ultimately going to get them into action. So there's a fear of missing out element to this discussion. They're missing out on wealth building. However, the biggest emotional piece that we're doing is, oh, by the way, not only are you leaving tens of thousands of dollars on the table, but you still have to blank. And blank is whatever they're leaving, whatever they desire to leave to move into this new home. So in this case, if I really want to like drive the wedge a little harder here, you're going to leave $38,000 of wealth building opportunity on the table over the next 12 months, and you're still going to have to live with your parents. You're going to leave tens of thousands of dollars on the table, and you're still going to be in the apartment paying rent, which, by the way, is not even factored into this math either. You're going to leave tens of thousands of dollars on the table and still kind of have to deal with being in the house that's a little too small for you and your growing family. I think it's okay for you as a salesperson who genuinely cares about the motivation of that buyer to have this discussion with them. In fact, I think you have a moral imperative as a real estate economist to share this information with them. Let me give you one more thought on this, then we'll move on. I would always, always, always rather go through something like this, thoroughly explain it to my buyers and sellers and database, and have them say, all right, I get it, but we're still not going to buy. I would rather a year from now, 2 years from now, 3 years from now, them come to me and say, I really should have listened to you back in 2024 when we were talking about this. I really should have listened to you in Q1 of 2025 when we were talking about this. I would far rather them say that than I would 2 years from now, that person come to me and say, why didn't you tell me? Or I wish you would have told me. Or if I had only known that's what was going to happen, then I would have bought. So if you feel like I'm preaching at you a little bit, I am. But that's also part of the reason that we're here is to take something that we know about the market because we've been living in this zone for about 18 to 24 months, but to explain it in what I believe to be a very irrefutable way that is meant to cause a motivated buyer to get unstuck. This is not about, let me be clear, this is not about manipulating buyers into doing something that's not right for them. This is about just saying, hey, before you really say no and sit on the sidelines for another year, let me make sure you know exactly what you're saying no to. If you take nothing else away from today, it would be this slide. Okay, cool. Take a deep breath. Let's keep moving. We just covered all three here in the buyer demand side with some extra color commentary around it. The seller side will move a little bit more quickly because there's not a ton for us to cover there. A lot of what most markets are dealing with right now is just sort of wishy-washy buyers and this massive amount of pent-up buyer demand that will break loose at some point in time. But I'm trying to get some of your buyers off the fence sooner rather than later because of this versus them just following the herd. But let's go over to seller supply. Three pieces of this: new construction, resale, and then the third that I've added to this, if you've seen me talk about this before, is incentives and tax policy. So here we go, real quick. Here's a graph. This is inventory related. Your blue line is new construction inventory. Your red line is resale inventory. No real surprises here. Some of these peaks and valleys in the new construction are just kind of getting a little overbuilt and then being too cautious, and then getting a little overbuilt and then being too cautious. Right now, you're starting to see kind of a surplus of inventory at the starter home level. Nationally, that tends to be just more because those are the buyers who are much more rate sensitive. And as the rates have stayed higher for longer, builders have acquired or stacked up a little bit too much inventory. So you see, though, their reaction, which creates another thing for buyers that we didn't even really talk about yet, is incentives that builders are offering. And if you're a listing agent, you've got to be mindful of competing with that in your resale inventory. But what you'll notice here on the existing home or the resale portion, 4 months worth of inventory nationally, that still is technically a seller's market. So we're in a spot where mathematically most of you are in sellers markets, but the behavior of the market is much more like a buyer's market, as a combination of like builder incentives, sellers' willingness to negotiate. There are times in history where the emotional reactions of markets are different than what the math is actually saying. And we're in one of those zones right now. I don't know how much longer we'll be there. Some of that is rate dependent, but that's sort of where we are right now. So that creates an opportunity for your buyers. But the thing I'd also share with you for benefit of your sellers, which is one of our talking points for today, is you as a seller, you still have to be really, really purposeful on how your property is positioned relative to the other active inventory. So here's the two tricks. And if you nail this, you're going to dramatically increase the probability that your house sells. Number one is condition related. What I'd be telling sellers right now is that your house has to be a 10 out of 10. Now, wordsmith this however you want to, but just me and you talking out of school here, what you know is that it can't be an 8 out of 10 and sell. I mean, maybe, but it's not going to sell at or near list price. But the houses that are selling right now, condition-wise, are 10 out of 10. They're able to compete with new construction. They're able to have a buyer walk in and not have to do anything, or at a minimum, only do a little bit of cosmetic stuff. Where we run into challenges with listings that are sitting for the most part right now is the seller who loves their house. It has issues that make it like a 6 or a 7 or an 8 out of 10. But as an agent, we're not willing to go in there and call their baby ugly and tell them what needs to happen to get it to a 10 out of 10. And inadvertently, what we've done is we've given them a false sense of hope. And so I want to encourage you in a way that feels genuine and authentic to you to make sure your sellers know that condition wise, we've got to be a 10 out of 10 to compete with this new inventory that's built up and the incentives that builders are offering that we do need to compete against for those buyers' eyeballs. So that's strategy number one. You've got to be at the top in condition relative to your active comps. The second piece of this is you've got to be in the bottom 1/3 of price relative to your active comps. So this is not about cutting the price for purposes of a fire sale, but let's say that you are one of 9 properties for sale in a comp area, whatever that represents, a neighborhood, a school district, whatever. In your price range, in your geographical area, you're one of 9. You got to be one of the bottom 3 in price to give you the highest probability of selling. So if you're a 10 out of 10 in condition, you're in the bottom third of price relative to the active comps, you have by definition given your seller the highest probability of selling. Where most listings get stuck is they're a 7 or 8 out of 10 in condition. And out of those 9 properties, they're like number 5 or 6 in price. And we get some showings, but we don't get any offers. We're a little frustrated. The seller's confused, and round and round we go. So over the river and through the woods we go to say, yes, your resale inventory is still in a seller's market. New construction inventory is in a buyer's market. The blended version of these is probably balanced to slightly still advantageous to sellers. And positioning is key for your listings. All right, here's a similar graph for the sell side. We looked at the buy side a little bit earlier. Not surprisingly, this is going to mirror that. Let's look at age group. Primary reason for selling: want to move closer to friends or family. Here we go. Let's look at this 59 and older age group. Look at that. Number one reason by far for those people. Then you go down here to like 25 to 43. Not surprising. This is like move up buyers, growing family kind of stuff. And then job relocation always shows up as one of these. So again, this is like demographic diversity. This is making sure that those people, like, so here would be like a little sub bullet point underneath this. Don't assume that because one of your past clients bought their first home from you 4 years ago and they have a 3.5% interest rate and a good house in a good neighborhood, don't assume that that means they're going to stay there forever. Don't assume that they don't want to leave that fixed interest rate, because 31% of the young ones say they're moving for a bigger house. 37% of kind of the older millennial group moving for a bigger house. That's a pretty big number. Is life events driving those things? I will say also, and some of you have heard me talk about this before, for those people, particularly this younger group who's like, use the stereotypical example of their first house or their first townhouse or something like that, and they bought it sometime, 3, 4, 5 years ago, and they have a great fixed rate. The best time for them to sell that property is never, like all caps, never. Sure, there are going to be little circumstances that are unique, but broad strokes here, they should never sell that house. And the reason they should never sell that house is because they got lucky. Most of them got lucky and tripped and fell into one of the best things that one could have as a real estate investor, and that is super low interest rate long-term debt. So their cash flow numbers would look really great on that as rental rates have continued to go up. Obviously, each situation is unique, but what I really want you to be talking about with these people who are in like this 25 to 43 is I want you to be working with them on how they could, and work with your local lenders on this too, to figure out how you can use some of that equity that they've built over the past 5+ years and use that as a vehicle for them to be a move up buyer while still keeping house number one. You're like, all right, cool, that's a good idea, but what does that do for inventory? We're going to get to that in just a second. Right now, we're just talking about how you, as a real estate advisor, are helping the people in your database understand wealth building through real estate. Best time for them to sell that is never, all caps, full stop. Okay. Number 3 in seller supply. This is kind of the new edition. This is a very, very abridged version. I will only pontificate on this just a little bit. Please do your own reading on this. These are incentives and or potential, underline, potential tax policy changes. I think one of the silver linings about housing and politics is housing is a topic that's really important to both sides of the aisle. And housing is one of the big cornerstones of the U.S. economy. And each of the presidential candidates on the campaign trail discussed various ideas. The incoming administration has discussed various ideas, but here are some. And these are not bulletproof by any chance or by any stretch, but worth discussing. This is about creating additional inventory. What could we do to create more supply for our country that by most accounts is somewhere between like 4 and 6 million housing units underbuilt? 4 to 6 million housing units underbuilt. So number one could be less restrictive zoning. You've seen this in most of your municipalities. Um, and every area is different, but there's a lot of this like not in my backyard kind of stuff. And if your area was open to pursuing less restrictive zoning, which might be something you could get involved in as a realtor in your local community, that could create some incentives for builders to build and therefore have more inventory. The second one, yeah, it's expensive. It's not lost on me, but you've got some of these big urban areas that, as a result of COVID, big empty commercial office space, turning that into multifamily space. That's going to be very market specific and very expensive to do, but is on the table. Number three, a better trade agreement with Canada on lumber. High tariffs on that and proposed even higher tariffs on Canadian lumber makes it more expensive to build houses. It's a disincentive to the construction industry and, for that matter, to remodeling. But that could be a way. The fourth one is the one that I'm most interested in. And keep in mind, too, just to be clear, like these are all ideas that are being floated around. To my knowledge, none of them have any meaningful legs underneath them at the moment. But small is relative, investor seller tax credit. So here's the setup. This is not my idea. I'm just passing it along to you. The vast majority of real estate investors are either accidental landlords, and or they're kind of like mom and pops who own less than 10 units, less than 10 doors. And so the theory is that if you created a short-term tax credit for those investors to become sellers, um, obviously that has some impact on the rental market, but hang with me here. And instead of that investor having to pay a lot of tax on the proceeds from that sale, there is some partial or perhaps even full tax credit to offset that. What you're looking for here is you're looking to be stimulative to seller demand or seller inventory creation, not stimulative to buy side, which I'll talk more about in just a second. But this is kind of a way, potentially, of unlocking some listing side inventory that does not create another buyer in the market. So let's say particularly you're in one of these like high net inbound markets, you already have more buyer demand than your inventory can solve. Um, Builders are kind of trying to fill that gap, but what you've also got is you have a lot of inventory owned by these investors that own less than 10 doors, and they're just sitting on them, whether that's part of their purposeful portfolio or not. But imagine some percentage of those rental doors now become resale opportunity. Probably also skews more toward the lower end of the median sale price in your market, which is also helpful for that lower end buyer. This one's interesting. I'm going to pay close attention to it. I think you should as well. Here would be the other thing that you could take this and run with for now is be real clear about who the people are in your database who own more properties than that one that you sold them a few years ago, or that one that you're aware of that they live in. It's sort of like they live in that house, but you didn't know that they inherited a house from their parents and bought a house at the college town for their oldest kid, and et cetera, et cetera. And you think they own one piece of real estate when actually they own four, because this could turn into something where that person that you're already in communication with becomes a seller of three properties in one swipe. That could be pretty cool. The not so good ideas, this is again personal opinion, but most of it's rooted in economics, political meddling with the Fed. I'm not going to talk about it, but it's a bad idea. Large tariffs that impact housing construction. We talked about how the Fed's watching that closely, and tariffs are, by all accounts, inflationary. Overly restrictive immigration policy that constrains labor. We touched on that previously. And the one that is probably more popular and was certainly spoken about a lot on the campaign trail over the past few months is tax credits to buyers. And if you've been in this business a while, you'll recall, and I don't remember the exact year, I probably should look this up, but it's probably 2011, 2012, when there was a first-time homebuyer tax credit, and that was a pull forward of demand for those first-time homebuyers. I was still selling real estate at that point in time, and it worked. And it worked because it got buyer demand going. But what we had in that market on the backside of the Great Recession was we had excess inventory. So we weren't stimulating inventory creation, we were stimulating buyer demand. But now we're in a spot where we have plenty of buyer demand. It's just not active in the market. It's like sitting on the sidelines right now. What we ultimately have, though, is we have a supply constraint. So my suggestion would be for those of you who work on these types of things is that we need to play around in the things that are stimulative to seller supply, not things that are stimulative to buyer demand. All right. Um, well, I guess it linked out to that study. Stand by, please. I'll get this pulled up. I'm doing it that way. Here we go. Okay. So this gets us to an exercise that I'd like for you to do either kind of a little bit in your notes right now, or for the sake of time, I'd like for you to do for homework is we say, okay, all of that's good to know. We know the things that are driving buyer demand. We know the things that are driving seller supply. I'll give you my summary of predictions here in just a second. But based on that, what are the high priority actions that I can do that are within my control? Said a slightly different way, you can't control who moves to your area or doesn't. You can't control who moves out of your area or doesn't. You can't control what happens with mortgage interest rates. For the most part, you can't control policy decisions that might happen at your local level or your state level or your national level. You can have input, but at the end of the day, there are things that are well within your control. The amount of effort that you do, the skill with which you do it, et cetera. So your homework on this would be to say, what can I control for me? What are the actions that I can take within my control? What can I do for my family and those closest to me? What can I do for or with my team, if applicable? What can I do for or with my clients? And then after you've brainstormed all of those potential ideas as we sit here in business planning season for next year, then you're going to drill this down to, based on all of those ideas, what specifically will I do next? What specifically will I do if you're watching this live between now and the end of the calendar year over the next couple of weeks to use this as an on-ramp for 2025? What specifically will I do when I walk in the door the first business day of 2025? What I don't want you to do is to say, all right, cool, lots of information here, but ultimately my business is just going to mirror whatever happens in the market. I think it's important to know. I think it's important to explain. But at the end of the day, you and I can only control the things that we can control. And I'm asking you to drill it down into those. I don't know why it wants to keep doing that. Sorry for let's click it a different way. Here we go. Thanks for hanging with me. Predictions for 2025. I got just a couple little things for you here, and then we're going to wrap up. Most of this I've already said, but I wanted to summarize it for you. Rates are likely to stay higher for longer. Inflation is likely stickier than most people think. I personally would be surprised if we saw anything in the fives for any meaningful period, if at all. I think it's possible that we're going to see, based on some negative headlines later in the year, if those happen, we could dip into the fives. But there's just really nothing right now, at least in the data, that would suggest that we're going to find our way there or stay there for too long. Tale of two markets based on if you're in an inbound market or an outbound market. If you're in an outbound market, then just make peace with the fact that that's the case. Find those sellers who are moving. Understand that you're going to need to carry more listing inventory in all likelihood. It does not mean that business is going away. It just means you're going to have to work a little harder to find it. And if you're in one of those inbound markets, really focus on how you're going to gain that larger portion of market share of those inbound buyers, because those inbound buyers also become sellers for you years from now. I think in those inbound markets, you're probably going to see 5 to 8% home price appreciation. Outbound markets, probably 3 to 5% declines, probably going to average out to 3-ish in gains nationally, which would meet sort of a balanced market historical norm. I think the worst is behind us on transaction count. We talked about that earlier. More fits and starts based on interest rates and marginal gain in transaction count. So I might see us at 4.3 to 4.5 million nationally. So let's call that I don't know, 7 to 10% gain in units. That's probably going to look like more in the back half of the year. But you'll get a seasonality tailwind in early January. You'll get a seasonality tailwind probably in the spring market as well. All right, what do you do? So here are my suggested actions for you, and then we'll wrap up. Number one, if you're still dreaming about 2021, time to move on. Sure, we'd all like to go back to what the market was like then and the amount of money that most agents made back then. I'd be really surprised if you ever saw that again in your career. So if you're still holding on to that, or if you're hopeful of some big snapback rally to 6.5 million units sold nationwide, I'm going to propose to you as your friend that you move on. Number two, which we didn't touch on today, but I think is really important, is you got to take care of the engine. So take care of your body, take care of your mind. You're going to need them both. Don't hear this as next year's market is going to be tough, or that we're headed for some major recession or something like that. There are no indicators of that out there. In fact, everything points to 25 being marginally better than 24 from a real estate market standpoint. But bring this marathon approach to things. Like you're a business athlete, and your body and your mind is going to have to be strong to run that marathon instead of sprints, which kind of leads into that consistent focus. This is sort of a duh statement, but I think, and I can probably speak for most of us here today, is that this consistency is something that can be a little bit evasive. So you're consistently focused on the things that you can control, and just keep moving. We talk all the time in coaching about how the rhythm that you're in is often more important than the speed. So if given two choices, being consistent and rhythmic in the things that you're doing compounded over time, or like running at something really hard, getting it done, and then crashing and burning because you run out of energy or time or whatever, that consistency of rhythm is where it's at. We really honed in on some of this today, the skills piece. I think if you can help your buyers understand the hidden cost of waiting, if you run teams, I see in a lot of teams a precipitous drop off between the skill level of the team owner and the skill level of the other agents on the team. So if you're a business owner right now and you're thinking, man, if only my people could say this the way that I do, if only my people could do this the way that I want them to, one of your biggest opportunities is to figure out how to fix that. And whether that's training or plugging them into coaching or spending more time with them, like closing that skills gap is going to dramatically increase your conversion rate. So you're not going to need as many at bats. Final thing here, hope is not a strategy. You've heard that 1,000 times in your career. The market's going to do what it will do. And my rhetorical question to you for today is, what will you do? And those are the actions that you can control. All right. Thanks for being with us here today. There's a couple of things that you're probably aware of. We just launched a podcast recently. We're about 4 episodes deep into that. You can find us on all your podcast platforms. You can scan this QR code. We'd love to have you join us for those conversations. We'll be dropping some more episodes in January as we get on the other side of the holidays. And you can find all the cool resources, both free and ways to plug in with us for coaching, over at middletonelitecoaching.com. And if you're watching this live, you're going to get a recording of all of this along with the slide deck. So thanks for being here. I trust you got a lot out of it, and let's go make 2025 our best year yet. Thanks, everybody. See you soon.